Imagine turning $10,000 into $2 million in under a year, then losing it all in a single afternoon. This is the dot-com bubble. In the mid-1990s, a strange new thing called the Internet was crawling into homes. Nobody understood it. Everybody wanted in. In 1995, a tiny company went public. Its stock rocketed 400% on day one. Wall Street took notice. Suddenly, slapping .com onto any business name became a golden ticket. Pet food, groceries, even dog toys. Venture capitalists threw cash at anything with a website. Billions poured in, often with barely a business plan in sight. Day trading became a national obsession. Regular people quit their jobs to trade stocks from home, chasing overnight riches. The new rule of business? Profits didn't matter. Only eyeballs, website visitors, decided a company's worth. One online pet supply store spent millions on a Super Bowl ad while barely making any sales at all. By 2000, .com companies were the single biggest advertisers during the Super Bowl, spending fortunes to grab attention. The Nasdaq index, packed with tech stocks, kept climbing and climbing. It felt like the party would never end. On March 10, 2000, the Nasdaq hit its all-time peak. Nobody knew it, but the clock had just run out. Behind the scenes, the Federal Reserve had been raising interest rates, quietly making it harder for money to flow so freely. Then came the earnings reports. Company after company revealed the truth: massive losses and no real path to profit. Panic spread fast. Investors who had piled in without a second thought started selling just as fast as they'd bought. Over the next 2 years, the Nasdaq lost nearly 78% of its value. Trillions of dollars simply vanished. Companies that seemed once unstoppable collapsed overnight. Online grocery delivery, toy stores, and countless startups shut their doors for good. But a few companies survived the wreckage. One online bookstore and one online auction site quietly kept building and became giants. The first big lesson? A company's stock price should eventually be backed by real profits, not just hype and hope. The second lesson? Speculation isn't investing. Buying something because the price is rising is a bet, not a strategy. The dot-com bubble taught investors a costly lesson about greed and patience, one the market seems to relearn every few decades.